Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior ETF Analyst for ETF.com. This week, I'm talking with Bryan Armour, Director of Passive Strategies Research for North America at Morningstar Research Services. Bryan, great to have you on the show.
Thanks for having me.
So, Bryan, we're sitting here just a few days removed from the end of the first half of 2023. So, naturally, it's a great time to talk about what just transpired during the first half as it relates to ETF. So, why don't we start there and specifically with flows? And I'd love it if you could tell us about the bigger picture. Maybe you can tell us about total inflows and what asset classes were in demand, and then we can drill down into individual ETFs.
Absolutely. 2023 started off a little rocky, and I think, growth stocks in particular really exploded out of the March lull that we saw, and stocks, became a really hot spot for investors in June. They added almost $60 billion in net flows to stock ETFs in June, and they're up to about a little over 100 billion year to date now. And so it seems like some of the conservative flows data that we saw earlier in the year, primarily inflows into fixed income, for example, have started to subside as investors are seeing the opportunity, seeing the recent performance in stocks, and jumping back in there. When we're looking at bond ETFs in general, we're mostly seeing fund flows go into broad index funds, but also a significant amount into active. And so when we're looking at things like dimensional, fund advisors has added $14 billion year to date. And then JP Morgan and JEPI in particular has added 10 billion, and that explains almost half of the flows into active ETFs. But they remain a hot spot for investors right now, where they're 5 or 6% of the ETF market by assets, but they're bringing in regularly about 20% of ETF flows.
Wow, that's incredible. That is incredible. So, Bryan, you did touch on the US stock ETFs and how they saw that big surge of inflows in June. I know I was scratching my head earlier this year when we weren't seeing any inflows for US equity ETFs, even though the market was ripping higher. It seems like when the stock market rally accelerated in May and June in the second quarter, it seems like investors finally couldn't ignore it anymore, and that's why they rushed in all of a sudden. Is that what happened?
Yeah, I think so. I think the caution that we saw from investors early on, it really centered around a lot of pundits and folks talking about fears of recession and how the Fed's interest rate policy would affect stocks in general, but I think in particular growth stocks. And once the performance sort of flipped around from 2022 and we started seeing a lot of what didn't work last year start to perform well, we slowly saw investors build their confidence, and jump back in. But for the most part, the categories that were receiving the most inflows were like large blend categories. So is effectively the way that it's still some caution. They're investing in more diversified products and staying away from maybe some of the nichier things that investors were big on in 2020, for example.
Gotcha. That makes a lot of sense. And yeah, we haven't seen huge inflows into speculative type of ETFs like ARKK, for instance. Now,
Right.
Bryan, I want to ask you about individual ETFs. I know you touched on a couple of them like JEPI. What type of funds were investors gravitating towards during the first half of the year?
Yeah, so broadly diversified index trackers were among the top funds for investors, and so looking at like Vanguard S&P 500 ETF EOO seemed to top the leaderboard. There's been, SPY inflows have been sort of up and down, but generally speaking, S&P 500 and total stock market ETFs have been some of the best. In for bonds, total bond market type funds, things that would fall into sort of the intermediate core category at Morningstar, and also government bonds, which, could potentially reflect an expectation that a recession's around the corner because government bonds don't have that credit risk that you have with corporate bonds. And if interest rates were to drop a little, long-term government bonds would benefit from their high duration. But BND would be the bond fund that we really saw. And then in terms of active ETFs, the winner was JEPI, which is the JP Morgan Equity Income ETF, and that one is a covered call strategy, and so it's a little different than the other ones I just mentioned, and it's a really interesting case because you know who would have thought in 2021, we're going through the meme stock boom, and now we have a subreddit for a covered call strategy that's hugely popular. And this thing is just bringing in money month over month. What it does is it basically caps the upside by selling an at the money call for a sort of lower volatility stock portfolio. What ends up happening with some of these strategies is they increase the yield. They're seen as sort of like a way to navigate choppier markets where maybe you benefit from uh, selling a call option if the stock market's really not going to soar. But what the problem is when the stock market does perform well, you don't know ahead of time, and so you could easily miss out on performance, which I'm sure in the second quarter of this year, many covered call investors have missed out.
Yeah, it's going to be interesting to see whether these inflows for JEPI continue if it kind of underperforms the broader market. Because I was looking, and as of today, JEPI is up less than 5% year to date versus more than 15% for SPY. Do you think that matters for investors?
Yeah, absolutely. It's going to be something that becomes front and center. And I think one of the things that gets lost in this is that, stock market doesn't follow a normal distribution of returns. And what I mean by that is there are fat tails where there are months or years where there are large moves down and there are large gains, and sort of like significantly abnormally large moves. And what happens with a covered call strategy or some of the defined outcome ETFs that we're seeing that are more popular is they do keep exposure to that fat tail to the downside, but lose exposure. They give up the exposure to the fat tail to the upside. So any sort of unexpectedly large move up or down tends to hurt these types of funds. And just over time, they tend to be come with higher fees than the market. If they were to just buy sort of a stock index fund, one of the best examples of this, if you look at the Global X NASDAQ 100 covered call ETF, which has a longer track record than JEPI, which is why I'm using this as the example, but it goes back about 10 years. It has, $7.5 billion in AUM, but over that 10-year period, it trailed the NASDAQ 100 ETF QQQ by 9.5% annualized. And so that's something where you just, as an investor, you just can't ignore that underperformance over the long term.
That's fascinating. So that is pretty significant underperformance in that ETF. Do you think JEPI is differentiated enough versus other covered call ETFs where it might outperform, maybe because it's actively managed, or do you think it's just going to end up being similar to those other covered call ETFs where inevitably it's going to underperform longer term?
Yeah, it's an interesting question. I think what we see is it has more of a low vol stock sleeve rather than something that's high flying like the NASDAQ 100 that, potentially has a different place in the portfolio. Um, but it's something that will get caught up in the same type of issue where we see it, it's selling calls against S&P 500, and so that's effectively going to force the fund to miss out on some of those returns. But I think it will be a maybe a less volatile version of the Nasdaq 100 cover call ETF that I just mentioned, although JP Morgan also has a Nasdaq 100 version of this JEPI strategy as well.
Gotcha. So around $10 billion of inflows into JEPI this year. Another ETF that's seen about $10 billion of inflows this year is QUAL, QUAL.
Hmm.
It's a quality ETF. And you did mention, Bryan, that people are kind of still worried about a recession and high interest rates and things like that. So this ETF might be a way to get stock market exposure while avoiding companies that are going to be hurt most by those things. Another one that kind of stood out to me was COWZ, COWZ, the free cash flow ETF. Probably benefited for similar reasons, inflows of $2.7 billion year to date. Do any other ETFs similar to these stand out to you?
Yeah, I mean, I think overall people are going into more broadly diversified ETFs, but yeah, I think Qual is a great example of a strategy that has worked really well in the last decade, let's say, where quality has been a really strong factor, especially when compared to things like value over that time period. And so I think people are rallying around it. They want stronger balance sheets in case of turmoil, and for that same reason, cows is gaining some attention as well because there's a lot of free cash flow coming into there. But part of the reason why qual is added so much is a shift in the way that BlackRock is running their model portfolios. And so it was effectively most of that came from sort of a rotation from an ESG ETF, which is their MSCI ESG aware, I believe, ETF, ESGU. They've sort of flipped from using that in their model portfolios to qual. And so we saw sort of like that negative flow mirror qual's inflow as an outflow in ESGU.
That's super interesting. A lot of people don't think of those two as being in any way equivalent. I think that's a great segue actually to talk about the outflows that we've seen this year. You've already mentioned ESGU. What other ETFs have investors been taking their money out of this year?
Yeah, we've seen a lot of money leave commodity space, especially energy in particular, and that is going to be a prime example of where we've seen outflows like XLE, for example, which is a select sector spider ETF for energy, and that's had lost almost over $4 billion. And so commodities and really an ESG is another prime example where the increased politicalization of ESG has only hurt flows in the US. It's become a little confusing with, BlackRock rotating their model portfolio, Larry Fink saying, I'm no longer going to use the term ESG. It's still going strong in Europe, but for the most part, flows have stalled and actually reversed in the US.
Yeah, it's going to be interesting to see, how ESG fares, especially next year with the whole campaign for the presidential election in 2024 heating up. Do you think that could actually have an impact in terms of flows? Because, a lot of the flows are driven by sentiment. So if people are, worried about ESG because of the presidential election, could that actually impact ESG ETF flows?
Yeah, certainly. And I think it would be in two different ways. Number one, I think who becomes president could impact some of the fundamental growth out expectations for some of these more ESG centric companies. But also I think as to your point, as everyone's watching presidential debates, and I'm sure ESG and environmental issues are certain to come up. It could sort of drive a deeper wedge into to people's opinions on ESG as well.
What's your take though, Brian? Do you think ESG as a movement still has legs, or do you think it's kind of topped out, especially when it comes to ETFs?
It's a great question. I think there are some legs in the sense that like I think ESG can be a very personal topic for people and so there's going to be always there will be demand for it. But you know, to this extent, I don't know, and I think maybe some of the way that some of these funds express ESG by having sort of like these low active risk screeners that come in and sort of keep the sector weights. Maybe those aren't going to be the wave of the future for ESG. Maybe people will start looking for more ESG activities at the end of the day that can prove some sort of value to the environment, to social or governance types of concerns. And like we'll see what happens, but in terms of investing, it's a constant trade-off between do we want to solve problems or do we want returns? And it's not always they're not always going to go hand in hand, but they could potentially share some of the same outlook going forward if ESG begins to pose significant risks to companies.
Absolutely. Yeah, definitely there is that trade-off. It'll be interesting to see what happens. So, Brian, we've done a good job, I think, covering flows for the first half, but something else that kicked off towards the end of the first half was the whole spot Bitcoin BlackRock story. What
Yeah.
exactly happened with that? Is there anything truly new here?
Yeah, so BlackRock's filing sort of came out of nowhere and they had not filed in the past and for a spot Bitcoin ETF. And so it was a bit of a surprise. It wasn't something that seemed like a priority at BlackRock historically. That's clearly changed. I think Larry Fink, I forget if it was yesterday, it was this week, was on Fox Business and was talking about sort of the future of Bitcoin and how he wants to work with the SEC to make Bitcoin cheaper. So it's really interesting to follow the along with this story, and we've seen sort of some of the old players begin filing. We have ARKK, or sorry, ARK joining with them, and Fidelity and Wisdom Tree, Invesco, a bunch of others that had also sort of filed in the past, and they're all updating their filings as in response to BlackRock. And the main difference in what BlackRock's trying to do is build out a agreement between the listing exchange for the ETF and the Bitcoin exchange that they would be using to trade. And it came out right. The SEC asked for more specificity regarding the Bitcoin exchange that they reference in the filings because they didn't actually name anyone. And so everyone refiled and said Coinbase. And so Coinbase is going to be entering into a surveillance sharing agreement with NASDAQ, with SIBO potentially. And that will potentially give the SEC some some level of comfort with the overall surveillance of Bitcoin market, the underlying Bitcoin markets. And the way that I've seen people look at it is sort of standalone. Is Coinbase enough because it is the largest Bitcoin exchange in the US by volume? And if you look at something like Binance, that they effectively dropped all US dollar operations, all operations in the US in response to the SEC's lawsuit against them. But so Coinbase could be a good way in for regulators. The problem is that, this trades globally. Bitcoin trades globally. It trades across dozens of exchanges. So how well can you surveil that market for manipulation is a tough question. But whether Coinbase is enough or whether in conjunction with the futures market on CME could get it there, we'll have to see. But it seems like BlackRock is feeling like there's a good chance here.
Yeah, yeah, it'll be interesting to see what happens. And, a lot of people are pointing to that surveillance sharing agreement that BlackRock and NASDAQ struck with Coinbase as something that maybe, might finally appease the SEC. But it's kind of, bizarre to me since the SEC is suing Coinbase for operating as an unregistered securities exchange and clearinghouse. So how could having a surveillance sharing agreement with a company that's supposedly operating illegally be a good thing? I think it's kind of bizarre, but honestly, this is kind of subjective and really ends up being a judgment call by the SEC, right?
Yeah, absolutely. And it would solve some problems for the SEC in the sense that, they could get this monkey off their back, but also sort of solve for some of their issues with Coinbase and different exchanges. But yeah, it is really interesting the way it's playing out. Like the fact that this came out in the same month that the SEC's lawsuit against Coinbase became public is very interesting. I think that something that's gonna people are missing is that I think the exchanges in the SEC working on some of the details around that surveillance sharing agreement are going to be key to whether they end up approving or denying the latest round of filings. So we'll just see if that's not going to be showing up in filings. That's not anything that's going to be public. So this might be one where we just have to wait and see what the exchanges, what the SEC come up with.
Definitely, definitely. And in the meantime, I am keeping my eye on that discount on the Grayscale Bitcoin Trust.
Yeah.
Last I checked, I think it's around 27%, but it was as high as 44% just about a month and a half ago. So that does seem to suggest that the market thinks the odds of a spot Bitcoin ETF are much higher than they were in June, but it doesn't seem like it's a lock. Otherwise, that discount would be much smaller than 27%, don't you think?
Yeah, absolutely. And I think there are sort of two pieces to that. Like number one, there's certainly people speculating that Grayscale could have a spot Bitcoin ETF and could be taken out at NAV eventually, meaning they'll be able to sell with no discount. But it is opportunistic. The problem is that you're sort of conflating whether there will be a spot Bitcoin ETF with the Grayscale Bitcoin Trust becoming a spot Bitcoin ETF, which isn't assured at this point. And it's been a rough go for GBTC investors, and the fact that Grayscale went down the path of suing the SEC to try to get a spot Bitcoin ETF conversion for their trust rather than opening up a redemption program might, it doesn't turn out to be the best avenue for investors, but hopefully we see that discount continue to get smaller and smaller over time.
Great point. And Bryan, before I let you go, do you have a prediction? Do you think we're going to see a spot Bitcoin ETF this year?
I'm gonna go on the record and say no, not this year, but I think possibly next year is what if I have to time this, which is highly subjective and I have no idea, but I'm gonna go with next year.
Great, great. We'll take that. We'll take that. So, well, this has been a great conversation, Bryan. It's been an absolute pleasure, and I really appreciate you taking the time and joining us on the show.
Absolutely. Thank you so much for having me.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.